Bismillahirrahmanirrahim. This is the second video on elimination of unrealized profit on intercompany sales of inventory. In this video, we are going to solve exercises on downstream and upstream sales by cost method, and in the next video, we will solve problems on downstream and upstream sales by partial equity and complete equity method. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video help students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video benefits CPA, AICPA, ACCA, CMA, and other accounting program aspirants. We also hope that this video help fresh graduates who have joined the companies and want to refresh their learning on elimination of unrealized profit on intercompany sales of inventory by cost method. Let us start with solving a simple exercise on work paper entries in case of downstream sales. So Perkin Company owns 85% of Sheraton Company. Perkins Company sells merchandise to Sheraton Company at 20% above cost. During the year, Perkins sold to Sheraton goods for $450,000, and at the end of the year, Sheraton Company had sold all of the inventory purchased from Perkin to third parties for $675. Prepare the work paper entries necessary to eliminate the effect of the intercompany sales for the year 2011. Now, if the company sells 20% above cost, this means that if the cost is $1, then the selling price is $1.2. So the parent company in the year 2011 sells for $450,000, but we don't know the cost of this sales. This is the sales, but the cost we do not know. So if the cost is C, then the selling price is C times 1.2 because it is 20% above cost, that is 1.2 C. And if the cost is 100, then the revenue is 100 times 1.2, that is 120. Let us assume the cost in this example or exercise is C. Then C times 1.2 is equal to the sales, that is 450,000. So the cost of goods sold is equal to 450,000 divided by 1.2, that is 375,000. So the journal entry in the books of Perkin Company will be account receivable debit and sales is credit. The parent company will also record the cost of goods sold. So the cost of goods sold is debit and inventory is credit by 375. The subsidiary, that is Sheraton, will record purchase as purchase debit and accounts payable is credit by 450,000. Now, let me explain you a little bit of this summary of intercompany sales. The first column over here represents the sales and cost of goods sold by the parent company to the subsidiary. They have sold to the parent company for 450, and the cost of goods sold we have calculated is 375 for the parent, so they make a gross profit of 75,000. The second column represents intercompany inventory that was resold to the third parties. Now the parent company has sold for 600 and the subsidiary has sold to the third parties for 675, but the cost is not 450, that is the profit is not 225, rather it is 675 minus cost to the affiliated group, that is 375, and that is equal to 300,000. The third column, inventory on hand, represents intercompany inventory still on hand in the affiliated group. Now, in this exercise, since they are selling all of the inventory to the third party, so there is no ending inventory over here. Next, the intercompany sales should be eliminated, and for this, sales is debit and purchase is credit. Interestingly, account receivable of P company and accounts payable for S company automatically cancel out, so we need not to do anything here. Next, we are going to talk about some interesting relationship, and this is with respect to cost of goods sold. Let us take some hypothetical figures. Rather, let me explain you that we have beginning inventory. To this we add the purchases. So this give you the cost available for sales. We will subtract the ending inventory to get the cost of goods sold. So let me put some hypothetical figures. Suppose beginning inventory is 50, purchases are 100, so the cost of goods available for sale is 150, and we are suppose the ending inventory is 40, so the cost of goods sold is 110. Now let us look into the ending inventory and look into how the things may be. We look into two situations. If the ending inventory increases, so suppose from 40 it increases to 50, so the cost beginning inventory remains the same, purchases remains the same, and the goods available for sale will be 150, and the cost of goods sold will be 100. That means the cost of goods sold has decreased by this when the ending inventory increases. Let us see what happens if the ending inventory decreases, and suppose it decreases from 40 to say 30. So once again we have the beginning inventory 50, purchases are 100, and the goods available for sale is 150, and the cost of goods sold will be 120, and now it has increased. So what we can conclude is that if ending inventory increases, then cost of goods sold decreases, and this will increase the profit. And if the ending inventory decreases, the cost of goods sold increases, and this will decrease the profit. So there is an inverse relationship between cost of goods sold and profit, and there is a direct relationship between ending inventory and profit. Note that decrease in ending inventory decreases profit, and decrease in profit is credit. I have said this specifically because we are going to apply this concept in the exercise to follow, or rather the exercises to follow in this video. Let us look into the relationship between the beginning inventory, purchase, cost of goods sold, and profit. Just now we have talked about ending inventory, and now we are going to talk about the beginning inventory. So we have now beginning inventory, and let us see what happens. First of all, let us assume that the beginning inventory increases from 50 to say, okay, let me write it down. It increases from 50 to 60. So purchases are 100 and the goods available for sale is 160. Ending inventory is 40 and the cost of goods sold is 120. So the cost of goods sold increase with the increase in the beginning inventory. Let us see what happens if it decreases. So suppose it decreases from 50 to 40. So purchase are 100. So the goods available for sale is 140 now. We have ending inventory of 40 and the cost of goods sold will be 100. So there is a decrease in the cost of goods sold. So increase in the beginning inventory will increase the cost of goods sold, and this will decrease the profit. And the decrease in the beginning inventory will decrease the cost of goods sold, and this will increase the profit. So beginning inventory and cost of goods sold have a direct relationship. We can just put it in the over here as well. Cost of goods sold, let us make a T account. So increase in beginning inventory will increase the cost of goods sold. Same is the case with purchase as well, because purchases and beginning inventory are added, and if the ending inventory increases, the cost of goods sold is going to decrease. You can see the relation over here. So let us apply this concept in an exercise, and the exercise is over here. This is the work paper entry, and this is similar to the previous example, except that now we are going to look into for 2 years, 2011 and 2012. So we have sales for 2 years, and At the end of each year, Sheraton Company had in its inventory one third. Before they have sold all, now there is an ending inventory of equal to one third in this case. So this exercise is obviously a variation of intercompany sales of merchandise where the unrealized profit of a downstream sales is to be eliminated. So we can see that Sheraton Company has in its inventory one third of the amount of goods purchased from Perkin during that year. That means that they have sold such sales amounted to 450 at the end. So one third of 450 is 150,000. So there will be an ending inventory of 150,000. So let us look into the intercompany sales, and there are two alternatives to solve this situation, alternative 1 and 2. Let me explain the first one. The intercompany sales is 450 and they are selling two-third. So one-third is on hand, that is 150, and the cost of goods sold is and they are selling for the subsidiary is selling for 300. So the cost of goods sold for 450 will be 450 divided by 1.2. So 450 divided by 1.2 is 375 and the gross profit is 75. For the cost of goods for the sales to the third party, once again they are selling 300, they have sold for 300 and not 450, and the cost of goods sold for this is again 300 divided by 1.2, that is 250. So first of all, we are going to talk about alternative 1, and we are going to first eliminate the intercompany sales of 450. So sales is debit and purchase is credit. Now the ending inventory is 150, but actually the cost of ending inventory is 150 divided by 1.2, that is 125,000. This is the actual ending inventory. So the company is making a profit of 50,000 by selling two-thirds of its inventory, while the 25,000 of profit that is reflected in the intercompany sales must be deferred until it is sold to outside the affiliate group. So the intercompany profit, we have 75, but one third is still there. So one third of 75 is 25,000, and this 25,000 is residing in the ending inventory of S company. Now this profit has not yet been realized by the consolidated entity through sales to outsiders, that is the third parties. So the unrealized intercompany profit of 25,000 must be reduced from the consolidated net income and from the inventory balance in the consolidated balance sheet. And the work paper entry to accomplish this elimination and to reduce inventory on both the income statement and the balance sheet is as follows. Ending inventory income statement is debit and ending inventory balance sheet is credit by 25,000, and we have made this entry to eliminate the deferred unrealized profit of 25,000. Now Another way of recording this transaction is we record the sales of 450. Rather, what we do is uh, we are going to reverse the original sales of 450,000 and the cost of goods sold recorded by the P company, and then the cost of goods sold by S company um, on resale of goods to the third party is 50,000. So the cost of goods sold by Sheraton is 300, which is not correct. And the cost of goods sold is 300 divided by 1.2, that means 250. So the cost is overstated by 50,000, and that's why we have credited it as well. The inventory on hand is overstated on Sheraton's books by 25,000 as unrealized profit. So this has also to be eliminated. So basically, it is the same entry, that is, rather than we credit by 450,000 the purchases, sorry, what we have done is we have split it into 375 and 50, that makes 425, and then we have eliminated the overstated ending inventory as well. Next, let us prepare the work paper entries to eliminate intercompany sales for the year 2012. And before we do that, let me draw a line over here just to make it convenient for you. Okay. So these were the general entries for the year 2011, and all the entries that we have done in 2011 are the work paper entries, so they are not shown in the subsidiary books. The subsidiary book still shows the inventory for 150,000. So the first thing to be done in the year 2012 is to reduce the beginning inventory by 25,000. You can recall that reducing the beginning inventory means reducing the cost of goods sold, and reducing the beginning inventory means reducing the beginning retained earning too. So let us look into it. So by reducing the beginning inventory in the year 2012, the cost of goods sold decreases for the year 2011. And when the cost of goods sold decreases, the net income increases for the year 2011. That is the beginning inventory for 2012. So the beginning inventory for 2012 is the same as that of the ending inventory, that is 150,000. And the beginning inventory of 2012 is the same as the ending inventory for 2012. And the debit to beginning in retained earning is interesting. In determining the consolidated net income in the prior year, 25,000 was deducted from the reported income, and thus from the retained earning of the affiliated group by a work paper entry. I would repeat again that work paper entries are not posted to the ledger accounts. So in order for beginning retained earning to match the 2011 year's ending retained earning, the 25,000 adjustment must be made to the beginning retained earning. So the elimination entry under the cost method or partial equity method is beginning retained earning is debit and beginning inventory is credit by this 25,000. To recognize the intercompany profit included in the beginning inventory and reduce beginning consolidated retained earnings for unrealized intercompany profit at the beginning of the year. Under the complete equity method, investment in subsidiary is debit and we don't debit beginning retained earning. So, and the reason is because the consolidated retained earning is identical to the parent's reported retained earnings, and that's why we don't make any adjustments. The debit to retained earning is replaced by a debit to investment in subsidiary, which serves simply to facilitate the elimination of this account on the work paper. So the work paper entries, first of all, to eliminate sales in the year number 2, you see there is a sales of 486. So sales is debit and purchase is credit by 486. We have all the similar calculations. We have 1/3 of this inventory on hand. So 486 divided by 3 is 162,000 and 405 and this 20% above cost, so that means 486 divided by 1.2, that is 405. So we have a gross profit of 81. We are having an inventory of 162, so 486 minus 162 is 324 and 405 minus 135 is 270, and we have the gross profit. Now once again you can see that the actual ending inventory is 135 and not 162. So 27,000 must be eliminated. So although the ending inventory is showing 162,000, it includes 20% of the intercompany profit. So actually the ending inventory is 135 and 27,000 must be eliminated. And this is the same general entry that we have done for the year 2011. Ending inventory income statement is debit and ending inventory balance sheet is credit by 27,000. I have put this solution in this Excel sheet as well in case if you find my handwriting difficult to read, or maybe I have made some mistake, and I apologize for that. And let us go to determination of non-controlling interest in combined income upstream or horizontal sales. So we are going to solve a problem on upstream, but before we solve the problem on upstream sales, let us go back to the elimination entry in case of downstream sales. And this was there were 3 elimination entries. First of all, we have eliminated the intercompany sales. Then the second one was the intercompany profit in the ending inventory was eliminated. This was the second one, first and second. Now these 2 elimination entries will be done in upstream sales also. However, while making the third one, we have to eliminate when we are eliminating the deferred unrealized profit it will be different in case of upstream sales, because when the subsidiary sells to the parent company, the parent company will have to identify what part of the purchase is a non-controlling component and what part uh, is a controlling component. So that is what we are going to solve in this illustration or a problem that is there. And P company owns 90% of the stock of Segal company. The stock was purchased for 810 on January 1 when Segal company retained earnings were 150. The financial data are presented here. You can see we have the income statement, we have the retained earnings statement, and we have the balance sheet. The January 1, 2013 inventory of P Corporation includes 45,000 of profit recorded by Segal Company on 2012 sales. During 2013, Segal Company made intercompany sales of 300,000 with a markup of 20% of selling price. Now this is interesting. If you can see, look into the previous example, it was 20% above cost, and in this illustration or in this problem it is 20% of selling price. So obviously it has to be calculated differently, and I will explain that as we progress. The ending inventory of P Corporation includes goods purchased in 2013 from Segal Company for 75,000. Prepare the consolidated statements work paper for the year ended 2013 and prepare a T account calculation of controlling interest in consolidated net income for the year ended December 31. So we will be looking into all these things, and uh, just keep one thing in mind, that we are going to solve this problem by using the cost method, and it is assumed that there is no difference between the book value and the implied value, as the focus of this problem is to explain how to look into the inventory accounts in case of intercompany transactions. So you can see that the inventory in this example is overstated by 45,000, and since it is from the year 2012, that means that the beginning inventory of January 1, 2013 is overstated by this amount. Now during the year 2013, which is the current year, Segal company made intercompany sales for 300,000 with a markup of 20% of selling price, and the ending inventory of P company include goods purchased from Segal for 75,000. So we are going to look into 6 different issues in this problem. The first one is that since we are going to use the cost method to solve this problem, the first general entry will be about the reciprocity. The second will be the intercompany sales of 300. The third will be the unrealized profit in the ending inventory of 75,000. That is includes the profit of the intercompany sales. The fourth is the beginning inventory is inflated by 45,000. Fifth is that there is a intercompany dividend payment of 60,000, and then so we have dividend, intercompany dividend, and the sixth will be the elimination of investment in the subsidiary. Now as I just now said, that in the previous example the markup was on cost, but in this the markup is on sales. So in this case the selling price or the sales is going to be equal to cost plus profit, and this is selling price times percentage because this is 20% of selling price. Let me put this as sales here. So sales is 300,000 is equal to cost we do not know the cost plus profit, that is 320% of 300,000. So 300,000 is equal to cost plus 60,000. So cost is equal to 300,000 minus 60,000, that is equal to 240,000. So 75,000 of ending inventory includes 20% of profit, and 20% is equal to 15,000, and this 15,000 is the unrealized profit in the ending inventory of 75,000 that needs to be eliminated. Next, let us see how to record the work paper entries. Remember that we are using the cost method, and since the cost method does not keep the investment account up to date, we will establish reciprocity. And let me talk a bit about reciprocity. Now, on January 1, 2009, when P Company acquired 90% of the common stock of Segal Company, the Segal Company's retained earning was 150,000. And when we compare this earning with the beginning retained earning of Segal Company for the year 2013, you can see that the beginning retained earning in the year 2013 is 180,000. It has increased by 30,000, and we are going to talk a little more about it as we progress. So we have the work paper entry for reciprocity. First of all, uh, we have seen just now that on the date of acquisition, the retained earning was 150,000. The retained earning on 1st of January 2013 is 180. So there is an increase of 30,000, and since the ownership is 90%, sorry, so that is equal to 27,000. And this is basically summarizing for 4 years, that is 2009, 2010, 11 and 12. And since the P Company has acquired 90% of the common stock of Segal Company, so 90% is 27,000, is the 27,000 is the reciprocity, and the first thing we do is to record this reciprocity. So investment in Segal Company, or that is the subsidiary, is debit by 27,000, and beginning retained earning for the P Company, that is Pay Company, is credit, sorry, this is 270,000, 27,000, and we are going to record this, and this will be recorded in the balance sheet, and we are going to record in the retained earning as well. This is the first work paper entry, and this will be in the beginning retained earning. So the beginning retained earning for beginning retained earning was for the S Company, and this is the first general entry. For how much? 27,000 for P Company. So this is the first journal entry. And this is for 27,000 credit, the beginning retained earning, and investment is going to be debit, and investment will be in the balance sheet. And the investment in the balance sheet will be debit, that is transaction number 1, work paper entry number 1, and that is 27,000. Okay. The second work paper entry will be to eliminate the intercompany sales and unrealized profit in the ending inventory for the year 2013. Now, that is easy. We are going to eliminate the intercompany sales. Now, and to eliminate this, sales will be debit by 300,000 and purchase will be credit by 300,000. So I would like to record this journal entry again in the consolidated financial statement. First of all, we have the sales. This will be in the income statement, and this is debit. This is transaction number 2. Sales is debit by 300,000 and purchase is credit by 300,000. Transaction number 2 by 300,000. Let us go back again, and you can see that there is a the ending inventory of 75,000, but this is not correct, as the actual cost of goods sold by the parent company is 180,000 and not 225,000. So there is an addition of 15,000 in the ending inventory in the form of an unrealized profit, and this must be eliminated. So we are going to debit the ending inventory income statement and credit the ending inventory balance sheet to eliminate unrealized intercompany profit in ending inventory. So we will be this will be the work paper entry number 3. So we have ending inventory income statement. Here we can say cost of goods sold, if you like, by 15,000, and ending inventory balance sheet is credited by 15,000. And once again, I would like to record this in the consolidated financial statements. We have ending inventory, transaction number is 3 for 15,000, and from the balance sheet again, ending inventory, transaction number 3, and this is going to be 15,000. Okay. Next, this is number 2, and then we move on to number 3. We are going to eliminate unrealized profit in the ending inventory. So this is the third work paper entry to eliminate unrealized profit in the ending inventory of 2012. The January 1, 2013 inventory of P company includes this 45,000 of profit that is recorded in the by Segal in the year 2012. So this 45,000 of inventory from 2012 sales is resold this year, and since this is an upstream sale, so the 45,000 will be split between the parent company and the non-controlling interest. Now parent company has 90% and the non-controlling interest has 10%. So we are going to debit beginning retained earning by 40,500, that is beginning retained earning for P company. 90% of 45,000 is 40,500, and the non-controlling interest is 10%, that will be 4,500, and the beginning retained earning is going to be credited by 45,000. To recognize the intercompany profit realized during the year and to reduce the controlling and non-controlling interest for their share of unrealized profit at the beginning of the year. And once again, let us record in the consolidated financial statement. So we have the beginning retained earning, and this was for whom? Beginning retained earning for the P company. So this is transaction number 4, and that is for 40,500. And then we have for the non-controlling interest, and for non-controlling interest it was the beginning non-controlling interest of 4,500, that was debit by 4,500. So that is transaction number 3. Let us move on to transaction number work paper entry number 4. And in case of work paper entry number 4, we are going to eliminate intercompany dividend. And you can recall that the subsidiary has declared a dividend of how much? Dividend declared is 60,000, and 90% of this dividend is recorded as dividend income by the parent company. So, and since this is an intercompany dividend, we have to eliminate. So we will first of all debit dividend income, and this is debit by 54,000, and we will be crediting that dividend declared 54,000 to eliminate the intercompany dividend, and we are going to record it, and this is transaction number 5. So let us go into the consolidated financial statement. First of all, there is a dividend income. Transaction number is 54,000, and then we are going to go for the dividend declared in the retained earning. It was 54,000, so we have, where is it, 60,000, and we have number 5, 54,000. Now the parent company has earned a dividend of 54,000 of dividend declared by the subsidiary, and obviously this is eliminated, while the remaining 6,000 is allocated to non-controlling interest. Just keep this thing in mind. Okay. Next, we are going to go for the, this was transaction number 5, transaction number 6, 4, no, this is transaction 1, 2, 3, this is 4, and this was 5, and we go to number 6 now. Sorry for that. This is number 6, and we are going to eliminate the investment account and we are going to create the non-controlling interest. So remember that first of all, let me show you that the investment is 810,000. But if you can remember, the reciprocity investment was debit by 27 as well. So 810 plus 8 plus 27 is what we are going to eliminate. That will be 837. And we are going to eliminate the equity of the subsidiary, and equity of the subsidiary is the beginning retained earning plus the equity of the subsidiary 750, and we are going to create the non-controlling interest. Now that will be 10% of this 750, that will be 75,000, and 10% of 180, that is going to be 18,000. So 18,000 plus 75, 93,000. So we are going to record this as work paper entry number 6. So beginning retained earning, and this is for S company to be eliminated, 180,000, and the common stock S company again debited by 750,000. Investment in S company was 180 plus 27, that is 837,000, and we have just now shown you non-controlling interest of 93,000. And once again, I am going to record this in the consolidated financial statement. We have investment, first of all, we have the retained earning of, so we go to the retained earning, and under the retained earning, it was number 6, 180,000. Then balance sheet, we have the equity of 760. So this is number 6, and this will be 750,000. Then we have to eliminate the investment, and investment was credit. So where is investment? In the balance sheet, and this is number 6, and how much was it? 837. And then we have the non-controlling interest, and that will be in the balance sheet, that is number 6, and that was 93,000. Okay, so this completes the 6 work paper entries, and we are going to start with the compilation of the consolidated financial statement, and let us see how we do that. So we start first of all from the income statement. We have the sales of the parent company, we have the sales of the subsidiary, and then there is a debit, so we will be subtracting the debit amount. So this will be equal to 2,145,000. We have dividend income, that is 54, and there is a debit of 54, so that makes 0 as our dividend income. So the total is 2,145,000. Then we have the beginning inventory, and beginning inventory is 225 plus 165, and I think I missed something over here. Oh yes, beginning retained earning of 45, that was number 4, 45,000. So we have 225 plus 165 minus 45, and this will be equal to 345. Then we have purchases of 1,275,000 plus 525 minus 300,000, that will give you 1,500,000. So we have the cost of goods available, that is 345 plus 1,500,000, that is 1,845,000. Then we have the ending inventory, and note that in the income statement ending inventory is subtracted. So P company 210 plus 172 minus the debit of 15,000, that gives us 367,500. So next we can calculate the cost of goods sold or goods available for sale, that is 1,845,000 plus minus the ending inventory of 367,500, that is 1,477,500. Other expenses in the parents is 310 and the subsidiary is 206. So the total will be cost of goods sold plus other expenses 310 plus 310 500 plus 206 250 516,000 516,750. So the total cost and expenses will be plus 1,477 500, and that is equal to 199,4250. Okay. And then we are going to get the net income. So this is the net income, that is total revenue minus total cost and expenses of 1,994,250. So the net consolidated income is 150,750. Next, we will find out the net income for the consolidated section, and this is interesting. Now for this, we are going to calculate the non-controlling interest from the net income of S company. The total net income is 71,250, but we are going to add this 45,000 that we have already reduced this amount by crediting the beginning inventory. So the cost of goods sold decreased by this amount, which also means that net income must increase by this amount. And then the ending inventory was debited by 15,000, and this has to be subtracted. So the cost of goods sold will increase and the profit will decrease. So this amount should be subtracted, and that's why I said that this sheet must be although it is simple, but the rules must be in your mind, so that you can quickly analyze how the things are happening. So we are going to add 45,000 the profit that was deferred from the previous year and subtract 15,000, that is the intercompany profit that was in the ending inventory, from the net income of Segal company, and then we are going to calculate 10% of it to be determined. So we have 71,250 plus 45,000 and minus 15,000, and we will calculate 10%, and 10% of this amount will be 10,125. So this is for the non-controlling interest, and this amount has to be subtracted from the consolidated income statement. So this will be 140,625. So now, in case of any adjustments that are to be made when depreciation or amortization or expenses, we don't forget that we have to adjust the non-controlling interest. You can also see that the consolidated net income is different from the P company's net income. Next, we are going to prepare the retained earning statement, and we start with the beginning retained earning. So beginning retained earning of P minus the debit and plus the credit, and that is equal to 798,000. The Segal retained earning 180 is credit and 180 is debit, so that is equal to 0. Just keep in mind that none of the subsidiary equity will exist in the consolidated financial statement. The net income will be copied from the top, okay, and I have to add up these figures. We have these two, but then look at the debit amount. The debit amount is how much? Debit amount will be 369,000 and the credit amount will be 345,000, and then we have the NCI of 10,125. So I will just copy these numbers from there. 369 and 345. And 10,125. I have simply copied the net income from this row, and the total is 140,625. Next, we will look into the dividend declared, and for the P company, obviously, we are going to subtract this amount of 150,000. And don't forget that only the dividend declared by the parent company will exist, and that is 150,000. And the Segal company, you can see 60 minus 54 minus 6 is going to be 0. So once again we are going to make a total, and the total for the elimination is 589,500, and this is 426,000, and this is 10,000 minus 6 is 4125, and this is going to be 788,625. Next, we are going to complete the balance sheet. Rather, we have completed the consolidated retained earning, and we are going to prepare the consolidated balance sheet now. So we have cash for P and cash for S company, that is total is 168. Accounts receivable is for P company and S company will be added up, that is 488,250. Then we have the inventory for P company and S company, and there is a credit, so we are going to subtract the 15,000, that is the overstated ending inventory, that was the profit that was not realized, or that was the unrealized profit in the intercompany sales. So this is going to be equal to how much? 210. This will be 367 500. Okay. Then investment, obviously we have a debit and there is of 810 and there is a debit of 27 and the total of credit is 837 and must be 0. If it is not 0, then there is a mistake. And then we have other assets of 750 plus 630, that makes 1,380,000. So we make the total is 2,403,750. So this is the total for the assets, and let us go for the liabilities now. So the first of all, we have the accounts payable for the parent and accounts payable for the subsidiary, that is the total is equal to 150,000. Then we have other current liabilities of the parent and the subsidiary, that is equal to 172,500. Next we come to the common stock, and don't forget that only the parent company's capital will exist in the consolidated balance sheet, that is 1,200,000. The first cycle, obviously the credit and debit are going to be settling down to equal to 0. The retained earnings are going to be just brought from the retained earning statement, and that is 589 500, and then we have 426,000, and then we have what, 4,125, and then we have 788,625. Now this is coming straight from the retained draft flow of the retained earning. Then we go for the non-controlling interest, and you can see that we have for 4,500 that is debit, and there is a credit of 93. So this will be 93 minus 4 because this is an equity account. So that is 88,500. So 88,500 plus 41, that is 92,625. 92,625. Once again we are going to total the last, and you can see that this is 1,371 and this is also 1,371, and if they are not equal, then there is a mistake. The debit must be equal to the credit, 92,625, and we have now 2,403,750. So this completes our consolidated financial statement for this problem, and I have put this example in an Excel sheet. Maybe you find difficult to read my handwriting, or I have made some mistakes. This exercise I have done in an Excel sheet, so hopefully you won't be finding any mistake in this part, and you can verify your practice over here. So although it is the same, I don't think so that there is any mistake. I don't think so, but if there is any, you can verify from here. So next we look into the analysis of consolidated net income and consolidated retained earning. Now, consolidated net income is the parent company's income from its independent operations that has been realized in transaction with the third parties, plus or minus subsidiary income or loss that has been realized in the transaction with the third parties, plus or minus adjustments for the period relating to the depreciation, amortization, impairment of differences between implied and book value, etc. And then the consolidated retained earnings is the parent's cost basis retained earnings that has been realized in transactions with the third parties, plus or minus the parent's share of the increase or decrease in subsidiary retained earnings that has been realized in transactions with third parties from the date of acquisition to the current date, plus or minus the cumulative effect of adjustments to date relating to the amortization, depreciation, and impairment of differences between implied value and book value. We go to the next calculation, that is prepare the P share of Segal's income. Now uh, now the reported net income of Segal is 71,250, and from this we are going to subtract amortization of difference between the implied value and book value, and that is 0. We have already talked about it, as we wanted to look into the entries related to inventory. And then there was unrealized profit that we have already calculated before. Ending inventory income statement, that was 15,000, if you can remember. um, so the subsidiary plus the 15,000 plus the profit of prior year sales to P realized in transaction with the third parties, that was 45,000. So this is equal to 101,250. Now from this, PAY's share is 90%, so 90% is 91,125, and the non-controlling interest is 10,125, and the subsidiary income included in the consolidated net income will be 101,250. Now uh, then here then they ask us to prepare the calculation for the controlling interest in the consolidated income statement, and for this we are going to look into the PAY's net income, and the PAY's net income was 103,500. And there was subsidiary dividend of 54,000, and this is to be subtracted, so that is 49,500, less unrealized profit on 2013 sales to Segal, that was 0. Sorry, subsidiary dividend is 54,000. PAY's net income from independent operation is we subtract, so that is going to be 49,500, and we are going to subtract unrealized profit on 2013 sales to Segal, that was 0, plus the profit on prior year sales to Segal realized in transaction with the third parties, again this is 0. So the total PAY's income from independent operations that has been realized in transaction with the third parties is 49,500, and PAY's share over here was 91,125, and that is equal to 140,625. So the controlling interest in the consolidated net income is 140,625. And you can verify this number is over here as well. Uh, I have I have put the summary of the work paper entries for the cost method, and you can see that the only difference is in the third transaction to recognize intercompany profit in the beginning inventory, where we add up the non-controlling interest in the equity as well in the case of upstream sales. So this completes the problems on elimination of unrealized profit on intercompany sales of inventory. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. And if you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.